Welcome back to the Deep Dive. Today we're really digging into the latest from Labcorp Holdings. We're looking at their Q3 2025 performance, their strategy updates. We've got quite a stack of sources here. Earnings calls, research notes, market analysis.
Yeah, it's a really interesting picture they paint. Kind of a study in contrasts, actually.
How so?
Well, on one side, you've got this massive financial outperformance, huge innovation happening.
Right.
But then on the other, there's this strategic restructuring going on and this big legislative threat kind of hanging over them.
Okay, so our mission today for you listening is to unpack that. We want to get into the strong, double-digit growth they posted, look at where they're putting their money, M&A, AI tools, and crucially, understand that tension. The $50 million restructuring versus the $100 million regulatory risk.
Exactly. And that tension really is the core story, isn't it?
It seems like it. I mean, the headline numbers look incredibly strong. Labcorp delivered stellar adjusted EPS growth.
Yeah, jumped 19.4% year over year in Q3. That's huge.
And that was driven by margin improvements, acquisitions like Invitae being integrated successfully.
Right. But like you said, at the same time, they confirmed they're divesting or streamlining about $50 million worth of annual revenue.
Specifically in their biopharma services segment.
Yep. So the big question for you is, how do we square that circle? Stellar growth alongside these sort of surgical cuts.
Let's start with the financials then, because the numbers do tell a pretty clear story of strength, at least initially.
They really do. Enterprise level total revenue hit $3.6 billion. That's 8.6% growth year over year.
And that adjusted EPS, $4.18, you mentioned the 19.4% jump. That's the star, really.
It definitely stands out.
But, the real insight isn't just the top-line number. It's the efficiency they seem to have built into that growth. Was this just more tests being run, or did they actually get significantly more efficient this quarter?
Oh, it was absolutely efficiency-driven. You saw the adjusted operating margin. It improved a full 100 basis points.
Wow, okay.
Reaching 14.4%. And they backed that up with really strong free cash flow, too. $281 million just for the quarter.
So they're generating cash efficiently, optimizing operations.
Aggressively doing so, yeah.
And this efficiency focus, it seems even clearer when you look at their updated guidance for the full year for 2025.
Right.
They narrowed the revenue growth range a little bit, lowered the midpoint by, 40 basis points?
Yeah, mainly citing foreign currency translation effects and, interestingly, the timing of acquisitions. Deals closing maybe a bit later than they first thought.
Okay, so that revenue adjustment sounds more procedural.
Precisely. It wasn't a demand issue, just deals didn't close exactly on the calendar date they expected, slightly shifting the total sales recognized this year.
Right.
But here's the really telling signal of their operational strength. Even though they slightly lowered that revenue target.
They raised the EPS guidance.
They raised the midpoint of the adjusted EPS guidance by 5 cents.
Okay, so that really does suggest the margin strength is powerful enough to overcome things like closing delays or currency headwinds.
Absolutely.
So where's that impressive margin expansion coming from primarily?
Overwhelmingly, it's the Diagnostics segment. That's the powerhouse right now.
Okay.
It's seeing really strong organic demand. And the integration of Invitae, their big genetic testing platform acquisition, that seems to be paying off really well.
We heard Invitae was accretive, meaning it added to earnings right away.
Yeah, accretive in Q3, and they expect it to be slightly accretive for the full year. Getting integrations like that right is absolutely key if you're going to keep up an aggressive M&A strategy like theirs.
Makes sense. Okay, let's dive into diagnostics then, because like you said, that seems to be the high-performance engine. Revenue up at 8.5%, strong organic growth at 6.3%. But I want to focus on the quality of that growth. Organic volume grew, 3.5%?
Right.
But the price and mix component grew 3.7%, more than volume.
And that price mix increase, that's the really critical data point for you to notice. It means the average revenue they get per patient session is going up.
So it's not just about selling more basic tests.
Exactly. It's about selling more complex tests or maybe bundling more tests together in a single session. It points to deeper engagement with doctors and a real strategic shift towards higher value services.
And you can actually see that shift reflected in their esoteric testing mix, right? The sources showed it's becoming a larger slice of the diagnostics pie.
It is. It jumped to 41.4% of diagnostics revenue in Q3, up from 38.7% just last year.
And that's where the margin expansion really comes from, these more complex tests.
That's exactly it. Esoteric testing, think areas like oncology, complex genetics. It needs highly sophisticated equipment, expert staff. It's higher complexity, higher barrier for competitors to enter, and fundamentally higher margin.
So that steady increase in the esoteric mix is really the heart of their profitability plan. Now, to keep this momentum going, they have to keep expanding their reach, their network. Their strategy seems to be positioning themselves as the partner of choice, especially for hospitals and local health systems.
That's spot on. They're using M&A really effectively to expand geographically and get better access to patients and providers. And this quarter showed a pretty impressive slate of moves.
Like what?
Well, they signed agreements to bring in assets from Empire City Laboratories that strengthens their position in the crucial New York tri-state area.
Okay.
And also Laboratory Alliance of Central New York, so more regional consolidation.
And it's not just buying assets outright. They're doing management deals too.
Yeah, like the agreement they signed with Crouse Health, Labcorp will manage their inpatient labs.
That seems like a smart model.
It is. The hospital gets rid of an operational headache, and Labcorp gets steady volume and gets embedded deeper into that health system's workflow.
And we shouldn't forget that ongoing integration of the outreach business assets from community health systems. That's across 13 states, right?
Yep. That one's huge for cementing their regional dominance. Plus, they completed the acquisition of select oncology and clinical testing assets from BioReference Health this quarter, solidifying their leadership in oncology testing.
Okay, let's shift from geography and M&A to innovation. What were the sort of aha moments in their high-growth specialty areas? Oncology first.
Right, oncology. They're aggressively expanding their comprehensive genomic profiling suite.
How so?
Well, they expanded their OmniSec Insight test. Now it can evaluate ovarian tumors for something called homologous recombination deficiency, or HRD.
Which helps guide specific therapies.
Exactly, really targeted stuff. And they also got the first and only CE marking, that's the European certification, under the new IVDR rules for their PGDX LEO tissue complete test.
That's for tissue-based tumor profiling.
Correct. It shows they're really pushing for global leadership in these complex oncology diagnostics.
Any movement on making screening easier?
Yes, actually. They're partnering to expand access to Genoscopy's Colosense test. It's an RNA-based colorectal cancer screening.
And the key is making it easier for patients.
Right, using a new simplified at-home collection method, trying to democratize that screening access.
Those are significant oncology advances, definitely. But I think the real headline innovation this quarter was in neurology.
Oh, absolutely. The Alzheimer's test.
They introduced the first FDA-cleared blood-based test to help diagnose Alzheimer's disease, specifically in specialty care settings for now.
This is a truly profound development. Think about it. Historically, diagnosing the amyloid pathology linked to Alzheimer's meant expensive PET scans or an invasive spinal tap to get cerebrospinal fluid.
Yeah, not easy or cheap.
So having the first FDA-cleared blood test, even if it starts in specialty care, that's a massive leap forward. It dramatically lowers the barrier to getting that initial diagnosis.
And they're not stopping there, are they? They're planning to take it even further.
Right. Their plan for early 2026 is to offer the only FDA-cleared blood test that can actually rule out that amyloid pathology, but in a primary care setting.
Wow. Primary care. That's the real game changer.
That's the huge market shift. Think about the implications for you, for everyone. It moves that initial screening out of the specialist's office, out of the often bottlenecked hospital system, and puts it right into your general practitioner's office.
That could potentially screen millions more people.
Millions who were previously maybe overlooked or who just didn't want to go through the invasive tests. This could fundamentally change the market for early neurological diagnosis.
And Labcorp is positioned right at the front of that potentially lucrative space.
Clearly positioning themselves as the leader, yeah.
We also saw some movement on the consumer side, right? Labcorp on-demand tests.
Yeah, keeping that momentum going. They launched new ones, one for lead exposure, another for ApoB, which is related to heart health, and a panel focused on healthy aging.
So definitely prioritizing that patient-driven demand alongside the traditional physician referrals.
They absolutely recognize that patients are becoming more sophisticated healthcare consumers. Offering direct access testing, it's partly a new revenue stream, sure. But it's also a way to potentially funnel patients towards more complex, necessary testing down the line.
Okay, now let's pivot. We need to talk about the flip side of the business. Biopharma laboratory services? or BLS.
Right. The other major segments?
Segment revenue was up 8.3% overall, which sounds good, driven by strong growth in their central laboratories unit.
Yeah, Central Labs did well, up 10%, or 7% in constant currency.
But the early development part of that business showed some noticeable weakness.
You did. And Labcorp was pretty clear that the weakness was really just due to timing.
Timing of what?
Delayed study starts. Revenue came in lower than they anticipated simply because clinical trials weren't kicking off as quickly as expected.
Because it wasn't like they were losing deals.
No, they emphasized that their RFP numbers, the requests for proposals they get, and their win rates stayed consistent. They aren't losing market share. The overall drug development pipeline still looks strong.
It's just the actual start dates for some trials slipped.
Exactly. A slowdown in the clinical trial initiation process itself.
And that delay seems to have directly led to this strategic surgical decision to restructure part of that business.
Correct. I mean, if you have a strong long-term backlog, but you're facing some short-term operational delays or inefficiencies, it makes sense to prune the parts that aren't really pulling their weight.
So that's the $50 million restructuring action.
Yeah, they're divesting or restructuring, which often means site consolidation, about $50 million of annual revenue in what they called non-core areas within early development.
Okay, maybe explain for our listener, why is cutting $50 million in revenue seen as a potentially positive strategic move? That sounds counterintuitive.
Because it eliminates drag on the business. The sources specifically noted that these non-core areas were actually negatively impacting accretion.
Meaning they were losing money or barely breaking even?
Essentially, yeah. These were likely lower margin, perhaps less efficient parts of the early development operation. So by taking what looks like a loss on the revenue line,
They actually improve profitability overall.
right, they create a more streamlined business, and they explicitly said they expect a slight improvement to overall operating income as a result. They're choosing profitability and efficiency over just chasing low-quality volume.
Makes sense. And despite that short-term turbulence in early development, the longer-term outlook for BLS seems stable, supported by the backlog metrics.
It does. Their trailing 12-month book-to-bill ratio is still strong at 1.09.
Meaning they're booking more future work than they're completing right now.
Correct. And the total backlog stands at a hefty $8.6 billion.
Wow.
So that strong backlog really confirms that the study start delays seem to be more transient operational hiccups, not some fundamental problem with demand for their services.
Okay. And that brings us neatly, I think, to how they plan to solve some of these efficiency puzzles longer term.
Yeah.
Technology.
Yes. This is where their strategy gets really interesting, maybe even crucial. They're leaning hard into advanced tech.
And it seems like it's not just for driving growth, but also potentially as a defense mechanism against some of those looming financial threats we mentioned earlier.
Exactly right. Look at Labcorp Test Finder. That's their new generative AI tool they developed with AWS.
What does it do?
It's a tool for clinicians, for doctors. It's designed to help them select the right diagnostic test using just plain language search like you'd use on Google.
Ah, okay. So simplifying test selection.
Right. And by making it easier, they increase the odds that doctors will choose the optimal test, which, as we discussed, is often the more complex, higher value, esoteric testing.
Which drives that beneficial revenue mix and margin expansion.
Precisely. So AI for clinicians helps drive revenue quality.
But they're also deploying AI internally, right, for operational efficiency.
Oh, yeah, big time. They're investing heavily in digitalizing their core lab operations, pathology, cytology, microbiology.
Examples.
They've deployed high-speed Roche slide scanners that helps move pathology workflows into the digital realm, speeding up diagnosis. And crucially, they've deployed a new FDA-cleared AI platform for digital cytology.
What does that enable?
It allows pathologists to view and analyze cell-based samples remotely and much more rapidly. This doesn't just potentially cut personnel costs over time, it improves turnaround times.
Which is a key competitive factor in this market.
Absolutely, speed matters.
And all this tech investment, it feeds into their longer-running internal efficiency program, right? The Launchpad initiative.
Yeah, Launchpad is still going, and they confirmed it's on track to basically offset the typical annual increases they see in personnel costs. It's kind of the baseline efficiency effort.
Okay, so Launchpad is the baseline.
But this new wave of AI implementation, that feels like the more aggressive move. And it feels like one they need to make, frankly, to prepare for that massive financial threat coming in 2026.
PMA.
P&A, the Protecting Access to Medicare Act.
Yeah, let's unpack that because it sounds like a huge potential headwind for the whole diagnostics industry, not just Labcorp. What exactly is the threat here?
Okay, so PMA essentially mandates cuts to the reimbursement rates Medicare pays for clinical lab services. Big cuts.
Why are the rates being cut?
Well, Labcorp and the industry group ACLA argue that the way CMS, the Centers for Medicare and Medicaid Services, implemented PMA was flawed. They say CMS based the new rates on inaccurate data collected mainly from the lowest cost, highest volume labs, ignoring data from smaller hospital and physician office labs.
Leading to inappropriately low rates across the board.
That's the argument. So they're heavily lobbying for a bill called the Results Act. It has bipartisan support, apparently, and its goal is basically to freeze those payment cuts before they take full effect.
But there's obviously a lot of political uncertainty around whether that bill will pass or if PAMA will proceed as planned.
Exactly. So Labcorp is taking what they call a prudent approach. They're planning conservatively.
And what does that mean in dollar terms?
They are building their plans assuming a full $100 million impact.
$100 million on both the top line and the bottom line for full year 2026.
That's what they're bracing for if PIMA goes through as currently scheduled. It's a massive hit. It could potentially wipe out a significant chunk of any planned margin expansion for that year.
Wow. So how do they defend against that?
Well, here's the crux of their strategic defense, and it ties back to the tech investments. They are already planning specific actions to proactively offset roughly $25 million of that potential $100 million hit.
Okay, $25 million offset. Where does that come from?
They explicitly stated that this $25 million is expected to come specifically from the new efficiency gains they're driving through those recent AI and digitalization investments we just talked about.
And that's on top of the savings they're already getting from the ongoing Launchpad program.
Correct. This $25 million is additional savings directly linked to the new AI and digital tools.
So it really frames their tech spending in a different light.
It absolutely does. It's the ultimate strategic question, isn't it? Can you deploy advanced technology rapidly enough, effectively enough, to actually neutralize a major regulatory risk?
They're essentially betting that using digital tools to speed up turnaround times and lower operational costs can save them a quarter of that PAMA loss before the regulation even fully hits.
That's the bet. It makes their technology spending not just, a nice-to-have investment for future growth, but potentially a critical necessity for survival, or at least margin protection, in a highly regulated environment.
Okay, so let's try and bring this all together for you, the listener. Q3 2025 for Labcorp was really defined by, well, overwhelming strength in the diagnostics segment.
Definitely. Driven by that organic growth and the successful integration of high-value acquisitions like Invitae.
Plus, some truly groundbreaking innovation in specialty testing. That Alzheimer's blood test moving towards primary care feels like a really big deal.
Huge potential there. But at the same time, they made that very pragmatic, maybe tough decision to cut about $50 million in what they saw as inefficient revenue from their biopharma segment.
Protecting margins, increasing operational focus.
Right. And looking forward, their entire strategy seems hinged on accelerating these AI and digital transformation efforts.
Because they see them as a critical lever, not just for growth, but to defend against that very real potential of a $100 million financial hit from PAMA in 2026.
Exactly. It really highlights the dual challenge they're navigating.
Yeah, on one hand, they're being really aggressive with M&A, specifically targeting those local labs and hospital systems.
Which, as you know, are often volume-heavy deals, but they can be initially lower margin until fully integrated and optimized.
Right. And on the other hand, they face this massive PAMA threat looming over their highly regulated and presumably higher margin Medicare business.
Absolutely. So the real question for you to think about is this. We see them using advanced AI and these efficiency programs like Launchpad to try and protect margins in the short term, especially against PAMA. But how successfully can that technology keep margins expanding consistently over the long haul? Especially if these potentially lower margin hospital partnerships start becoming a larger and larger percentage of their overall business mix. Can the tech outrun the mix shift?
That balancing acquisition volume versus technological efficiency gains, especially with PAMA hanging out there, that's really the journey to watch as we head towards 2026.
Couldn't agree more.
Okay, that's our deep dive for today. Thanks for joining us.